Hello again, everyone. It is Tuesday, June 14th, 2022. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my current most important charts, data series, and our own quantitative models that I think are going to be the most influential over the next several weeks and potentially even through the summer. So let's begin with number one, market internals. The Asbury 6 is negative. Those who know me through Asbury Research or through StockCharts.com know that the Asbury 6 is one of two tactical quantitative models that we have here at Asbury to indicate to us whether we are on a risk-on or a risk-off environment. Risk-on means we are in the market, we're looking for opportunities, and we're adding capital to the markets when we see new opportunities. Basically, our offense is on the field. Risk off is now we're playing defense. That means we are tightening stop on existing positions and we are raising cash, and we're really trying to make sure that we don't experience any significant losses because the market's internally weak. So the change here since the last time that we were together on StockCharts on May the 11th, just a little bit over a month ago, was the Asbury 6 has now switched to negative or risk off as of Friday, June the 10th. So here's the Asbury 6 here updated through yesterday, which was Monday the 13th. You can see all six are negative. All six of the constituents are negative. You can see that most of these switched to negative late last week. We have 2 on 6.9 and 3 on 6.10. So we had been positive prior to that, positive since May 26th. We had a nice little lead going, but the market basically ran into a brick wall, and we're going to have a look at that now. So you can see so far this year, we went to risk off on Jan 14, back to risk on St. Patrick's Day, March 17th, risk off April 12th, risk back on May the 26th, and now we're back to risk off again. Why did the rally die? Well, volatility was a really big part of that. When the Asbury 6 started to show some internal strength at the end of May, we saw a lot of good things happen, but one thing that did not happen is the market stayed afraid. We never got over that fear gauge, and that was a real detriment to why the rally didn't continue. Here's the VIX here, down at the bottom, going back to January, daily, corresponding chart of the S&P 500 is up top here. Since April 22nd, which is 9 days before the peak that we made here at the very end of March, the VIX got up above 24 and it stayed there. 24 is our line of demarcation between a pullback in a positive market or just a positive trend and a sustainable negative trend. So above 24 is negative in the VIX, underneath 24 is positive. So you can see that we had been positive here from March 18th to April 21st, all through in here, and then we went to negative here on April the 22nd and stayed there. Last week, we were right on the verge of breaking down underneath 24. We actually were sitting right on top of 24 from June 2 through June the 9th. We never could break it. Once we couldn't get down through 24, the VIX spiked up the other way. This was Thursday and Friday of last week, and that really triggered the decline. Number 3, know your levels. 2 S&P 500 supports are just below the market. But before we look at the supports, let's look at where the S&P 500 was last week. It was right underneath this overhead resistance level here at 41.15 to 41.78. It represented the February 24th low and the June 2nd high. The S&P hovered right in here for, I think, 9 trading days. While it was doing that, we were watching the VIX sit right on top of 24. So that was the fulcrum from us. That was the fulcrum point that we had to get above 41.78, and we needed to get down underneath 24 in the VIX. It never happened, and that really was the trigger that started the sharp market collapse that we saw at the end of last week, and we're seeing a little more today. Let's take a look at those supports. The first support level here is 37.23 to 36.94. That's the January and March 2021 lows. We're sitting on that area now. I see it as a minor level. I think the level that's much more important, and the one I'm going to be focused here on for the next week or so, is 35.88. That's about 4% underneath where the market is trading right now. That's a September 2020 high. Once we get down there, if we can hold that level and we can see volatility start to come in, and I can see some other good things happening in terms of the Asbury 6, some of those indicators starting to turn green or turn back to positive, then we will look at this as a possible bottom. But for right now, I'm looking at these as speed bumps on the way down. Number 4, influential stocks. Tesla is leading the market lower. The last time I was with you on May the 11th, this was one of the charts that was in your daily 5. And we pointed out that Tesla had just broken down on May the 9th, 2 days earlier, from this big sideways area of investor indecision. So it basically crashed through the 200-day moving average, and it broke out through the bottom of this pattern. We said that this was bearish, and we were looking for Tesla to go a lot lower. Since that day, it's dropped by 18%, and we're now updating through today. We're retesting the lows here, 18% from the March 11th period. This chart suggests that we could go down another 18%. That would be down to 540. If that happens, it's really important to me for 2 reasons. One, Tesla's the 5th largest stock in terms of market cap. So it has a lot of oomph. It has a lot of push in the market. It has a lot of sway. And number 2, the linear correlation between the S&P 500 and Tesla over the past 10 years has been between 0.75 and 0.88. In other words, it's been statistically significant throughout that entire 10-year period. So what does that mean? It means Tesla and the S&P 500 tend to move the same way most of the time. They tend to move with each other most of the time. So while we're trying to understand how low the S&P 500 is going to go, this is just a guide for me. It doesn't mean that the S&P 500 has to fall all the way until Tesla hits 540, but this is one stock that is giving me a downside target, and that downside target warns that we could be in for a lot more weakness in the S&P 500 as the summer goes on. Finally, when you're in a bear market, we've been in a downtrend since the beginning of the year. The market actually peaked for the year on January the 4th. A lot of investors, certainly a lot of money managers, they just can't fold their arms and go to cash. They have to do something. Our SEAF model is really good for this. Our SEAF model tracks the money flows around the 9 sector spiders to identify where the money's going and where it's coming from in the sector space. So the last time I was with you again back on May the 11th, we talked about the SEAF. I've been talking about it all year. It's been overweight energy since January the 4th. It's still overweight energy now. You can see it's one of the top 2 out of the 11 sectors in terms of assets in, all the way since the beginning of January. And you can see all the way across. It's one of the top 2 in 3 different time frames. The other one that is currently one of the top 2 is healthcare. Now, energy, since 110, when it first showed up in the SEAF model, XLE has risen by 52% outright and has outperformed the S&P by 75%. This is the only sector year to date that has made any money. All of the other 10 sectors are negative for the year, although some have outperformed the S&P. Actually, XLV which is the other sector pick according to SEAF, has outperformed the S&P by 8% since the beginning of the year. So if you're a manager or if you're an investor that has to be invested in the stock market, the SEAF helps to tell you where to go. This is especially important in bear markets because it at least will keep you in those places where the money's going so you could ideally capture some outperformance, which we did in XLE here. So there you go. If you like our approach to markets, I welcome you to visit us at www.asburyresearch.com and have a look around. Or you can go and visit us on our YouTube page and you can subscribe to more videos there. Thanks for watching and we'll see you at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.